Hello, everyone, and welcome to the monthly market monitor for today, June 14th, on Flag Day, and the day of the Fed announcement. A couple of housekeeping items. This webinar is being recorded, and a link will be sent out via email at the end of the presentation here shortly after. And if you do have any questions during the presentation, feel free to drop them in the Q&A feature or the chat function within the call here. So go ahead and get started. First with an economic update. Taking a look first at the unemployment rate. So the unemployment rate for May increased slightly to 3.7%. Which is up from 3.4% seen in April. So a slight increase here as we've seen over the past couple of years that unemployment rate declining. But now as more potentially layoffs from the tech sector are starting to happen, that unemployment rate has been ticking up recently. Taking a look next at the U6 rate, so the unemployed, those marginally attached or part-time looking for full-time, you can see here that's been trending steadily around 7%. And actually in May, we saw a slight increase to 6.7% from the 6.6% figures seen in April. Again, we're about below where we were pre-pandemic levels, so that's a good sign that we have a pretty strong labor market right now. Taking a look at initial jobless claims for the week ending June 3rd, we saw a jump to 261,000 claims from the prior week's 233,000. And it is hard to tell from, again, the graph, the scale on this graph with the large spike from COVID, but initial jobless claims have been continuing to trend up since the end of September last year. So, which would be, again, what we'd expect to see throughout the winter months, but as spring and summer started to roll around, we'd almost anticipate starting to see jobless claims maybe drop off a little. So again, initial jobless claims have been rising during a time we might see some decline in those claims. However, looking at continuing jobless claims, those have been slowly increasing as well throughout the fall and in the winter months. But we did see a pivot in April. So for the week ending May 27th, there were actually 1.76 million continuing claims, which was down from 1.7 million seen in the prior week. So although initial jobless claims have been going up recently, continuing claims have been slowly leveling off throughout the beginning of this year. Taking a look at job openings now. So the total job openings for April came in at 10.1 million, which was up from 9.7 million we saw in March. And since since March of 2022, job openings have been trending in the right direction, but are still, as you can see, at a highly elevated level as compared to where we saw pre-pandemic levels. And it did again, look like we've been making some progress down, but a little turnaround here in the total job openings in the recent couple of months here. Moving on from the employment data, we'll take a look at some retail sales data, which increased 0.4% month over month in April after 2 months of decline. This came in below market forecasts for a 0.8% increase. And looking at the so-called core retail sales, which excludes automobiles, gas, building materials, and food services, retail sales were up 0.7% month over month in April. On a year-over-year basis, retail sales were up 1.6%, which came in lower than the 2.4% year-over-year figure seen in March. And taking a little breakdown into some of the others, some of the different sectors, we saw some major increases in the motor vehicle and part dealers department, which was up 0.4%. Building material and garden supply stores up 0.5%. Food services and drinking places were up 0.6%. Health and personal care stores were up 0.9%. Merchandise stores were up 0.9% as well. Non-store retailers up 1.2%, and then miscellaneous store retailers up 2.4%, whereas declines were seen for gas stations down 0.8%, food and beverage stores down 0.2%, clothing down 0.3%, electronics down 0.5%, furniture down 0.7%, and sporting goods, hobby, musical, and books all lumped together down 3.3%. So based upon these different categories, you can see some of the more discretionary categories, things like sporting goods and hobbies or electronics. We're starting to see some declines in those areas, maybe seeing some consumers starting to pull back in some discretionary spending, but again, still kind of spending money on those necessity items. Taking a look at the personal savings rate, the personal savings rate as a share of disposable income for April came in at 4.1%, which was down from 4.5% seen in March. So at the end of last year and beginning of this year, we started to see, maybe we're hitting a rebound and starting to come back up, having more Americans starting to save money again. But again, after seeing things calm down from all that stimulus money that got pumped back into the economy, the personal savings rate is still at a level below where we were pre-pandemic level. Next, we'll take a look at some housing market data. So starting off with housing starts for April, that came in at a seasonally adjusted annual rate of 1.4 million. And this was up 2.2% from the revised March estimate of 1.37 million, and is also 22.3% below the April 2022 rate of 1.8 million. So you look back to March, April timeframe when we saw sort of a peak in housing starts, and production has coming down recently over the past year and a half, but looking back to where we were at pre-pandemic level on the left-hand side of the graph here, you'll see that we are still at a level that's highly above, or a little bit, I should say, above where we were pre-pandemic levels. Moving on to existing home sales for April, that came in at a seasonally adjusted annual rate of 4.28 million, which was a decrease of 3.4% from March. As you can see, the 2 months of decline in March and April is starting to sort of eat away at that sharp rebound we saw at the beginning of this year. And on a year-over-year basis, existing home sales were down 23.2% and continue to remain well below what we were at pre-pandemic levels. As more and more existing homes are becoming off the market, just not as much inventory, as well as borrowing costs continuing to rise. That's really putting a damper on the existing home sales across the country. So taking a little bit more in-depth look at existing home sales specifically from the National Association of Realtors April 2023 summary, the median existing home sales price fell by 1.7% on a year-over-year basis in April to 388,800. But as you can see from the graph, we're still sort of continuing that trend line upwards in regards to the median home sales price. And inventory of unsold existing home prices increased by 7.2% to 1.04 million in April. So that's a good sign that we're starting to see more inventory coming back onto the market. This is actually equivalent to about 2.9 months worth of supply at the current monthly sales pace. So again, not ideal conditions for the supply that's out there on the market. And Hopefully we'll see that more supply starts to come around for more purchases. Breaking down the existing home sales by region, the South, as no surprise, made up almost half of existing home sales in April. Obviously, there's been lots of attraction to the South lately with people looking to relocate. And for some, it might be, the warmer weather. Other people, it might be favorable tax conditions in states like Florida. However, I'd like to, turn your attention specifically to the bottom left-hand corner of this slide, where I dropped in some figures from another report by the NAR. And with the exception of the Midwest, which had the second highest sales at 24%, the South had a much lower median existing home price as compared to the Northeast and the West, which are two regions that many people have been recently leaving and relocating to the South. So again, the South has the second lowest median home sale price in the country. Not to say that the price is the driving factor behind these relocations, but it certainly is making a lot of sense for those individuals to leave an area that may have a higher living cost for a less expensive area, especially when you have the opportunity to continue your current job through remote working. And taking a look, for example, an apartment in New York, you might be spending a few $1,000s a month for that apartment. If you're not going into the office, you might not have a reason to stay in the area, and the South might look, attractive to you based upon the home prices there, something you can maybe afford a little bit better than, say downtown New York. So definitely makes a lot of sense for those individuals to go from maybe renting an apartment to actually owning their own home. And then taking a look at the existing home sales by price breakdown. So again, that 250 to 500,000 continues to be that largest contributor to home sales, with the other, 21% coming from the 100 to 250,000 range. So, adding those two together, roughly 2/3 of the homes being sold again are in those two price ranges. And then that, you can see the higher ranges a lot less. Not many people can, one, afford those. Plus, with the rising borrowing costs and things like that, it's been, harder to come by purchasing homes of that size. So speaking then of price ranges, so taking a look at the percent change in sales from a year ago, broken down by the price range. So one thing you'll notice is that the highest declines are in those top price ranges. One factor likely contributing to the large declines in higher priced homes, like I mentioned before, is that the high borrowing costs associated with purchasing those homes. Another one being that the growth in sales seen during the low mortgage rate environment is starting to unwind, as again, it's become more costly to borrow to purchase a home in those top price ranges. However, there's one other factor that I believe is having an impact on the sales in those top price ranges, being the shifting of prices from one down to a lower range, and then the home selling then within those lower ranges. So something many of you may have probably noticed recently as mortgage rates have continued to rise is price cuts. And a lot of those price cuts we've been seeing in those higher price homes. So again, not that those high value luxury type homes are not selling on the market, as you can see the large declines, but there's potential that some of those homes, instead of just not selling, they're shifting to these lower price ranges. And one example that, I have a personal example to share with you, that there's, someone I know that they're looking at selling their house right now. And they started off within, the higher range of that 500 to 750 price range. And within a month's time, they've actually already cut it to the very low end of that range. And, just based upon that situation, I wouldn't be surprised if they were to accept an offer, somewhere within that 250 to $500,000 price range. Next, we'll take a look at some inflation data. So I know this chart's really busy, but there's some good visuals that I'd like to point out to you here. So first being that the consumer price index decreased to 4% in May from the 4.9% seen in April. See in that top left chart here. This is the lowest level since March of 2021, and it also beat market expectations of a decline to 4.1%. So keep in mind that these are year over year changes, and the decline to 4% doesn't necessarily mean that prices are declining, but rather that there's a slowing of the price increases being seen. So we are still seeing some price increases in many categories, but one of those being that food, which is shown in the light blue bar in that top right graph there, coming in at 6.7% on a year over year basis. And then when you're stripping out food and energy, CPI slowed to a 5.3% level, which is the lowest level seen going back to November of 2021. As mentioned, many areas are slowing price increases, including food, which I mentioned before, down to 6.7%. New vehicles were down to 4.7%, apparel to 3.5%, shelter down to 8%, and transportation services to 10.2%. On the other side, energy saw an actual decline of prices of 11.7%, which is shown by that dark blue bar on the graph of your upper right-hand corner of the slide, which did have an overall major impact on the slowing of the overall CPI. Again, mentioned before that stripping out that food and energy, we saw that CPI slow to a level of 5.3%. So one thing regarding the energy prices, though, however, is that earlier this month during a meeting of OPEC Plus, Saudi Arabia did announce that they would be cutting an additional 1 million barrels of oil output per day starting in July, which was set to last at least 1 month. However, that could be extended depending upon the circumstances that come about with as we move forward this year. Oil analysts are not expecting this to cause a significant increase in the world crude oil prices. And the announcement made by Saudi Arabia stated that this decision was made to, the decision to cut was made to support the quote stability and balance of the oil markets. So in other words, what they're essentially doing here is they're cutting the production in order to prevent a material decline in the case that if prices did go down, to prevent a material decline in the prices in the event that demand would drop due to a potential recession. So essentially starting to get ahead of where we would, potentially see as far as prices. They're trying to pull back some of that supply to essentially mitigate those significant price declines that might come from a recession. All right, so moving on now to the WIRP screen. So with the slowing of the CPI that was previously shown, this did strengthen the Fed's ability to pause rate hike at today's meeting, which is exactly what they did. They did pause today. They did not raise interest rates. However, I would like to take a look, with you guys about the progression of these WIRP screens over the past week, just to show how quickly the consensus changed on what, would happen at today's meeting. So taking a look at that percentage hike / cut column for the 6/14 meeting. So this goes back to last week, 1 week ago today. There was still about a 34% consensus that there's a potential for an increase at today's meeting. But if we fast forward here to Friday, there was a little bit more consent, or I should say a little bit less consensus of a rate hike at the 6/14 today's meeting, down to 28%. So again, starting to slowly look like the potential of not even having an increase at today's meeting. Fast forward to yesterday, so after the CPI data came out, we take a look at this and it down to 11.8% chance or consensus that there would be a rate hike at today's meeting. So obviously today, like I mentioned before, there was no hike at today's meeting, but just wanted to kind of illustrate how quickly that consensus did change. I'd also like to draw your attention to that 7/26 meeting. So if I jump back one slide here, so looking back to last Friday, there was about a 52, 53% consensus that we'd potentially see a hike sometime between now and the July meeting. However, fast forward to here, now we're at 62%. And then after the announcement today, we actually saw it jump, going back 62 now to 69% consensus. So 62 to 69, that's just in one day. Part of that, I think, is from the Fed statement in their meeting today that said they still may need to raise rates again this year, with half of the committee actually expecting rates to increase by another half a point sometime this year. So whether or not that's true or not, that's to be determined. But again, you can see how quickly consensus changed last time, leading up to this Fed hike meeting. And this might be the Fed's way of just sort of calming the markets, not necessarily wanting the markets to go and explode again, saying, oh, the Fed's done hiking. This might just sort of be, them trying to calm the markets, let them know that they still have the ability to, and they will if they need to. But generally speaking, when we've seen a pause, we haven't seen a pick back up in hikes after that period. Moving on to a little bit of market data here. So taking a look at the yield curve on a month over month basis. So we got the green line, which is as of Friday, and then the yellow line, which would be 1 month ago from Friday. So you can see the 1 month is the only mover in the down direction. Everything else was up across the curve. Again, the belly of the curve, you're seeing a little bit wider of movements as compared to, the front and short end of the curve. Moving on to a year over year look at the yield curve, you can see that, again, significant increase in the short end of the curve on a year over year basis. We've been, seeing that the past several months, even the past couple of years, as again, the Fed has been raising rates significantly, which has been pushing up that short end of the curve. But again, not much movement on the longer end from about 3 years up to 30 years, not big movers there. Taking a look at the 2-year Treasury, these graphs again were pulled last Friday. The 2-year Treasury up to 459, almost 460, off the peak that we saw at the beginning of this year, but starting again to trend up on that 2-year Treasury curve. And then moving on to the 10-year Treasury curve, it came in at 376. Again, off the peaks that we saw at the end of last year, and then, again, moving up again at the beginning of this year, but trending upwards nonetheless. Taking a look at the overnight SOFR rate. So SOFR has been hovering around 505, and again, without the Fed hiking, actually pausing at today's meeting, chances are we're going to continue to see that level at 505 moving forward. Moving on now to 1-month LIBOR, that is continuing to track up now to 521. And then 3-month LIBOR, again, trending up since, the end of last year up to 554. Taking a look at the interest on excess reserves at the Fed. So again, like I mentioned before, they did not raise today, so we're going to be staying at that 515 level. And moving on now to the 30-year Fannie Mae commitment rate. So off the peaks that we saw at the end of last year, but similar to the 2- and 10-year Treasury, starting to ramp up again up to 620 as of Friday. And finally, looking at the MBA refinance index, that has remained flat and below levels not only seen during the pandemic, which again, we saw those low mortgage rate environment, but also from the years before the pandemic. Again, higher borrowing costs are leading to not as many refinances going on in the market. All right, so that's all I have for you today. I'm going to go ahead and check the Q&A and the chat just to see if there's any questions that are out there that may have popped up throughout the session. Currently, I'm not seeing any. Julie, I don't know if you see any, but that I might be missing. But if there are no other questions, we can go ahead and conclude. On the slide here, I do have my email address and direct line, as well as the investments department. If you'd like to reach out to us about anything that was presented either today, or if you have questions, concerns about where we're moving forward with the economy, feel free to reach out. We'd be happy to have conversations with you around those topics. All right, one last check. I don't see any questions coming in, so we can go ahead and conclude this session, and I thank you for joining us today.